Hi friends, welcome to our channel Energy and Precious Metals Weekly Review and Outlook. Crude prices fell last week for a fifth week in 7 over what analysts said were concerns that US inflation was just not slowing as the Federal Reserve expected, to the extent that it was now affecting consumer sentiment and retail sales as well. That may well be the case, but the oil market was clearly not talking about the elephant in the room. That is the biggest geopolitical crisis to hit the trade in years, one with ramifications as important to energy. We are talking about the OPEC plus oil production cut, the size and more importantly timing of it, that has got the White House all miffed. As Jonathan Panikoff, senior member at the Washington-based Atlantic Council, puts it, the decision by the Saudis steered and Russia-supported oil producing alliance to reduce output is probably not aimed just at President Joe Biden or the United States, but the manner in which it's being implemented probably is, and it has the potential to be politically damaging for both the president and Democrats, said Panikoff. The timing of the cuts to take effect November 1 week ahead of the US midterm elections, and their intensity removing up to 2 million barrels per day from the market probably reflect a willingness by Saudi Arabia to jab at Biden. Riyadh is not naive about the US political landscape. OPEC Plus almost certainly could have achieved its same overall goal but wait to act until shortly after the US midterms. That brings US Ponikoff's analysis of the fundamental problem between the United States and Saudi Arabia, a relative that's rife with misaligned expectations. Saudi Crown Prince Mohammed bin Salman, aka MBS, continues to demonstrate his preferences for global engagement that is transactional, similar to how both China and generally engage in the world. The problem is that's not traditionally how Washington conducts foreign policy, preferring long-term strategic relationships. MBS surely recognizes the broader global context of his decision making. Riyadh's support of the cuts inflects a conscientious decision to actively support Moscow at a time when the world knows the United States is working to challenge ability to successfully wage, including by limiting capital available to Moscow from oil sales. Inevitable, Riyadh will claim the cuts are in the best interest of Saudi Arabia, and that may be true. In the short term, a coming global recession might portend greater supply and risk pushing oil prices down further. In the long term, as global energy transitions away from fossil fuels accelerate, Riyadh might think that it only has so many years left on high oil prices to glean the revenue needed to reform its economy. But even if that is Riyadh's thinking, its behavior indicates a belief that it has nothing to lose on national security by allying with Russia as at its time. It's true that if the United States makes a hasty and unwise decision to immediately withdraw its security umbrella from Saudi Arabia, Washington risks seeing Beijing fill that gap. On the other hand, Beijing has long-term hesitant to play the role of a security guarantor, and China cannot completely fill the hardware gap that would exist if the United States left. Most prominently, for a yield in field in which China is still developing its capabilities. Riyadh may sincerely believe that the economic issues associated with oil prices are distinct from the security requirements from which it relies on the United States, but for Washington, economic security is very much core to national security. To that end, MBS needs to be careful. There are limits to how much the Biden administration is going to accept from a country that's supposed by a critical ally, even a transitional one. Almost every US president from the 70s to now, that's Richard Nixon to Joe Biden, have had problems with the kingdom and its love child called OPEC. The past 6 years, it's been OPEC Plus after the Saudis cooperating of 9 other players into the wider group. Many US commanders in chief had vented about the Saudis and the oil cartel, but ultimately did nothing about both. Donald Trump had mixed results through, despite him and his son-in-law being as chummy as possible with the House of Saud. Trump often waged a gleeful war of his own with the cartel through precision-guided drones to get oil prices down. The post-COVID collapse of crude prices was, of course, a game changer for Trump, making him contrite enough to lend the combined forces of the Saudis and a helping hand to put the oil market back together again. Enter Biden in January 2022, and nothing has been the same since for the Americans and the Saudis. In fact, almost every month has been progressively worse for diplomatic ties and the supply-demand situation in oil. The president's Paris state comment against Riyadh over the Jamal Khashoggi killing not helping. Biden's maiden visit to the Saudi capital in July was unsurprisingly more disastrous, with the president telling MBS on his face on Saudi soil that he thought the crown prince was responsible for the killing. Hence, a 5 lakh barrels per day production cut, originally conceived as a bridge building move by the Saudis in response to the visit, ended by becoming a insulting 1 lakh BPD at MBS order. Biden has to realize that he is not only butting heads with the source of the world's most critical oil supply, he is also up against a crown prince and energy minister, the latter being MBS half brother Prince Abdulaziz bin Salman, or ABS, whose combined egos are probably greater than the dignity of the rest of the Arab world. So comes the question, what could the White House hope to achieve in a political reset with the Saudis? With the midterm elections just weeks away, it's hard to think of anything the administration could do at this point other than to release more oil for the US reserve to bring crude prices lower. On the contrary, prices could actually rise on the new turmoil that's being created through justice seekers to Saudi extravagance would probably cheer. If MBS thinks it's alright to give Biden a jab below the belt just before the elections, it's probably not wrong either for the president to show the crown prince that he indeed has something below that belt to accuse him on the face of murder. Diplomatically, given how well things are going, it would not be surprising if Saudi Arabia is classified next as a state sponsor of terror by the State Department for its allegiance with the Kremlin sounds like the Iranians might suddenly have company. A withdrawal of arms deal could or would most likely follow. To that end, Ponikov says the bigger question is whether European Union countries would try to jump in to fill the military hardware gap instead, just as Dassault Aviation, the French Rafale jet manufacturer, came to an agreement with the United Arab Emirates to sell its jets shortly after Abu Dhabi called off the deal to purchase the US-made F-35. If so, it would undermine US leverage to redefine the contours of its relationship with Saudi Arabia. If not, the United States will have to decide whether it's going to try to compel Riyadh to re-engage with Washington in a strategic manner or accept a more transactional relationship, Ranikov said. But back to the question of why the oil market is surprisingly destined to the incredibly tense US-Saudi backdrop. Some say it's because such a showdown is quite unprecedented, with none of the OPEC-related crises of the past 60 years coming this close to rewriting the rules of political and diplomatic engagement between two of the world's most important allies. Simply put, oil traders do not know how to react at this point, as no one knows for sure how this is going to go, said John Cliduff, partner at New York energy hedge fund Again Capital. But one thing's for sure, it's not going away, so grab your popcorn, raise your recliner to your favorite position and release the pause button on your OPEC Plus TV for what is to come. Oil market settlements and activity. Crude prices were down as much as 7% on the week, giving back about half of the past 2 weeks gains after latest readings for US retail sales and customer price inflation showed the Fed was barely winning in its year-long battle against price pressures. The global growth outlook remains a major downside risk, along Craig Erlam, analyst at online trading platform Onada, said, pointing to new lockdowns in China, the world's largest crude oil importer, which has been fighting COVID flare-ups for a week-long holiday. With labor markets remaining tight and inflation stubborn, further downgrades could be on the cards, Erlam added. New York traded West Texas Intermediate crude did a final print of $85.55 per barrel after settling Friday's official session down $3.50 or 3.9% at $85.61 for the week. WTI was down just after 7%. US crude benchmark rose 17% over two prior weeks in a powerful state to October, after a 12.5% drop in September and 24% loss for the third quarter. London traded Brent oil put in a final print of $91.64 after settling Friday's session down $2.94 or 3.1% at $91.63. Brent had risen 13% over two prior weeks. The global crude benchmark was down 11% in September and dropped 22% in the third quarter. According to Sunil Kumar Dixit, chief technical strategist at the previous week's strong rebound in WTI could not keep pace in the latest week, stopped short of the weekly middle Bollinger Band of $96 as it faced selling pressure at $93.64. If WTI has any plans to continue grinding higher above $96, short-term